Hey, thanks so much, Barry, Peter, for joining me today. I'm really looking forward to this conversation. There's so much going on, of course, in the markets and with the Fed and with interest rates. Love to get your most recent thoughts. Peter, I'm going to start with you. I see you tweeting a lot about the commercial real estate space, something that I've been touching on. I'm curious as to what your overall thoughts are that's happening there.
Well, there are two things. You have the structural challenge of office, which ironically, I think if you're in if you have a good building, you're in a Class A building in a city or town that has population growth, I think you'll be okay. I think more people are going back to the office, but there are plenty of B and C offices that are obviously challenged. But I'm not saying anything new here. The other big problem is just balance sheet, because there are plenty of other healthy operating areas of real estate in terms of occupancy, whether it's industrial, multifamily, student housing, healthcare, uh, all with high occupancy rates. It's the problem is if you have debt coming due this year, and the debt that you have coming due this year was probably struck at 3% ish, give or take pre 2022. And if it needs to get repriced at, call it 8%, uh, and you have too much debt relative to the value of the building, that's too much. That's a big problem. And that's where really the focus is. People just assume it's just office, but you can have a multifamily apartment building that's 99% occupied, 98% occupied. And if you got your loan coming due this year, you're going to be underwater. And I see that firsthand. And I'm obviously reading about it. And I see what's going on out there. So I think that's the challenge. I mean, today, somebody's commercial real estate loan is coming due. Tomorrow, the day after. This is an ongoing process, and there's a lot of debt to work through, again, because of the very notable vertical rise in interest rates in a very condensed period of time after 15 years of salad days of cheap money financing. And so this interest rate shock, and when I say shock, I'm talking in terms of that vertical rise, is going to affect predominantly the interest rate sensitive parts in the economy, and commercial real estate is sort of right in that sort of eye of the storm.
Yeah, I
So
gotta
how do
say,
you play this?
I gotta
Oh,
just
go
say,
ahead, Barry.
Peter's spot on. It's an issue. It's two pronged, just like Peter said. If you are in the building, it's harder to collect rents because people don't need as much space. They're downsizing, and then on the other side, just like Peter said, man, you're lucky if you're at 8%, right? It's a 500 basis point rise, but you could have even been higher than that to start off with. If you're at SOFR plus 500 basis points, 600 basis points, that's not uncommon. You're in the 10, 11, 12% that you're paying. So that's a lot of money. Here's what I've been hearing anecdotally to just underscore Peter's point is that some people who own commercial real estate in the office space are so pressured by this that they're doing a cash out refinance to the max LTV, 75%, and then just saying, fine, I'll consider that a sale. In other words, I'll just take 75% of the value just to get from under this. I've heard this anecdotally quite a few times. So it just gives you an inclination as to how tough it is in this particular space right now.
So when does this hit us? When does this hit the economy?
Well, it's definitely already affecting not just that area of the economy, but also a lot of regional banks that have a lot of exposure to the space. Because not only do they have that exposure, but you also at the same time have the regulators telling these banks no more new commercial real estate loans, and you got to figure out how to work this out. And you really, your hands are tied in even refinancing it. So it's having an impact on the extension of credit from a lot of these regional banks that have outsized uh, exposure to this space. The other thing that it's impacting is it's limiting incrementally new construction. Now, no one's looking to build a new office building, of course, depending on where you are, but it's also affecting multifamily where there's an enormous amount of multifamily supply, and Barry can talk this, of course, coming online this year and early next year, but there's very little shovels in the ground today of new projects getting greenlit because of the high cost of capital, the sort of flattening out on the rents. Even industrial seeing a slowdown. It's just the economics are different in building a new building, regardless of what its use is for. And that's the other impact that's affecting. And that affects, of course, not just the real estate market, but it affects construction and everything that is derived from that.
Do you look at multifamily housing in certain markets to be attractive and you'd be interested in those opportunities? Or do you step back and wait and see how some of this plays out?
I think the best positioned real estate companies right now are actually the publicly traded companies. You know, the commercial real estate market's like $20 trillion, and the publicly traded REITs are a tiny sliver, like $1 trillion. But they have the better balance sheets predominantly. Now, granted, a lot of the private stuff, a lot of people have no mortgages, they have very low loan to values, so they can also be a beneficiary. When I say beneficiary, I'm talking about those that are able to take advantage of other people's woes. Because the better balance sheet is going to win, not only in surviving this time period, but also eating the carcasses of those that are not going to make it.
Yeah,
Barry, your thoughts?
it's really important to take a look very local, you know, and especially on commercial real estate. So like, for example, you could say, okay, what about the Florida market? Well, the Florida market's really, really diverse, you know, and it's diverse by zip code. Where I am in West Palm Beach, actually commercial real estate is really healthy and really strong. But you go to Miami and you're going to run into some oversupply there that could be worrisome. So it's going to be very localized. So, and we talk about supply coming onto the market, especially on the residential side. So residential real estate, you know, it's a tale of two things. One is activity, which we know is in recession, but then there's prices which have been supported and healthy. It plays such a vital role because the rental components, both owner's equivalent rent and rents, really determine Fed policy to a great extent, because owner's equivalent rent is 33.5% of core PCE, and you know, and also somewhere around 8% is just straight rents. There's a lot of confusion in this area because, as Peter said, there's supply coming on the market, which should be easing things. And if you even look at vacancy rates now are up to 6.6%. Close to pre-pandemic levels, and the trend is higher, so maybe there'll be more vacancy. But when it comes to tying this back into inflation, there's a disconnect. We all know there's a big lag, but people will look at the apartment list numbers. Now, apartment list just measures new rents, and year over year, they're down 1%. So that would seem like, okay, we're getting some relief, right? But that's a new rent. So just to simplify this, put your hat on as a landlord of a property where it's vacant and you're looking to take on a new rent. So my rent roll right now is 0. So I'm willing to horse trade a little bit because I want to get you in because it's better than 0. But if you're a landlord and you've got people living there, well, it's a pain in the ass to move, and landlords are smart enough to know that. So they will inflict a little bit of pressure, a little bit of pain, because they know that the tenant that lives there currently will pony up and pay that. So that's why those are going up closer to 5 or 6% a year. And they're willing to pay that because paying that is better than picking up my life, the hassle of it, the expense of it, relocating. That is, we've all been through it. We know that that's not a lot of fun. So that's the disconnect there. Now, owner's equivalent rent, which is the big thing, which is completely subjective. I mean, it's a very, the question is, I'll tell you what the question is. Don't quote me exactly, but it essentially is a question that's asked in a survey that says, if you could rent your home today, unfurnished and without utilities, what would it rent for? So that's essentially the essence of the question. We're all relatively educated, and the people that are listening to you are educated. How many of us know what that number is? Okay. Now ask somebody who's less exposed to this or less sophisticated. And then there's always an upside bias. Ask anybody how much their home is worth. You know, they view their home as a castle that they're going to. So that upside bias has to persist if you're asking somebody how much they'd rent their home for. And given that is such a huge component in pricing the most important price of the world, the price of money, 33.5% of core PCE, which is the Fed has said that is what we're going off of, it puts you in a quandary as to, why is the Fed not looking at something that is a little bit more data driven and less imputed driven to come up with really where inflation is.
So what are you seeing that they should be seeing?
I think that if you looked at trueflation, the trueflation numbers are about 0.8% lower than the numbers that we're seeing from the numbers we get from the BLS and the BEA. So that would be a big improvement. You take that's 0.5%. That gets you to pretty close to the Fed's 2% target. And trueflation uses like 10 million data points instead of overall inflation data we get from the BLS, like 80,000 data points. So, I think that the Fed needs to look at its benchmarks a little bit differently, because everything, and Peter could talk to this, you could talk to this, is that they rely upon is imputed. When we talk about the employment data, well, that the numbers that we get from the establishment survey and the birth, these are imputed numbers that they're using. So they're not good at inflection points. They're not good at accuracy. It's going to create mistakes and missteps, which we've experienced. We had too much inflation because the Fed made a misstep. They relied on imputed data, kept rates too low, too long, QE too low, too long. And we've seen it throughout history.
Same mistake on the other end of this seesaw where we are today.
I
think so. I'd love to hear what Peter thinks.
No, I agree. I mean, the Fed is, this is what you get when you try to price fix the cost of money. You overdo it, you underdo it, I mean, it's that's the beauty of the market. The market gets things wrong, but when it does, it quickly adjusts. The Fed is adjusting like a slow-moving aircraft carrier. That's the problem here. Now that said, I think the Fed, at least Jay Powell, he's focused on not just having inflation come down. He wants it to also stay down. So yeah, we can say, okay, well, prices go up, they come back down, and everything's fine because they're back down again. But staying down is an issue. And yeah, we'll see 2% prints through the rest of the year in inflation, and maybe even low 2%, and even maybe a high 1%, and we can say, oh wow, they're back to 2%. But that's not winning the war. That's winning a battle. Winning the war is keeping it there in 2025. And I think that is what Powell is most concerned about. His term goes to February 2026. He doesn't want to start slashing interest rates this year, only to have inflation skyrocket again next year, right into the end of his term. So this higher for longer interest rate environment is real and is going to be around. So yeah, maybe they do cut this year. Maybe they cut to 4.5%. Maybe they cut to 4%. That's 150 basis points of cuts, but that's a far cry from zero. And if the market doesn't like the Fed backing off from this inflation fight, maybe the 10-year yield goes back to 5%, while the Fed funds rate goes back to 4%, which ironically would mean we have an uninverted yield curve and actually a normal one again. But I can't discount that at all. I think that's a possibility. So this rate story is complicated on how it plays out, and then flowing through this is what the Fed decides to do with their balance sheet, because questions are now being asked of it. They're going to be discussing it at the March meeting. The $2 trillion reduction in the size of this reserve repo facility definitely is sort of facilitating these discussions, because we're all wondering when that gets drained down further from here, what does that mean for bank reserves in the Fed's balance sheet? And that flows through the rate story, and that is going to flow through the asset price story. QE lifted stock prices. QT in 2018 hurt stock prices. QT now, it has, in the minds of the market, they've been mugged by, or they've been drugged by AI, thinking that it doesn't matter. But I think as the year progresses, it will matter for both bonds and stocks.
Yeah,
drugged by AI. That's good.
That's a great line, and so many good comments, Peter. But I'd like to try and just add some color to what I think could be the key here for the Fed's actions in both rate reduction and balance sheet tapering of the reduction in the balance sheet, the runoff of the balance sheet. So what I think is the key is going to be the unemployment rate, because I've tried to do some math, and I could actually pull up a chart if you like and show you where it looks like to me the unemployment, the rate of inflation goes on core PCE, I think it's hard to get to 2%. But not saying we can't get there, but I think it's hard. It's really hard to get to 2%. You've got to average 0.16 a month for 12 months. And you think about what we just got 0.41 this month. So that's got to weigh through the system. That's almost 3 months worth of inflation that we've kind of now put in the rearview mirror. We were running at a 6-month run rate of 1.85. Now it's 2.46 on the 6-month. And Jerome Powell has told us they look at that 6-month run rate. So I think that that's going to be a tough one to go by. If we're just going to hang our hat on saying, okay, the Fed's going to cut because of inflation, it's hard. But the key for me is going to be what happens with the jobs numbers. So I believe that we have seen those jobs numbers not be truly reflective of what's going on. I think they're overstating the amount of job growth. Let's face it, last month's 353,000 was all a seasonal adjustment. The real number was down, a loss of 2,635,000 jobs. The 2,988,000 seasonal adjustment caused that increase. So, when you're looking at numbers that big, are we really right by saying it's 353,000? I mean, if you look at the household survey numbers, they can move a little bit more volatilely, but I think that the household numbers can't be ignored. And when you look at the exodus of people leaving the workforce, that's keeping the unemployment rate fictitiously low. Then you look at things like the hours worked, which are down a half an hour from the same period a year ago. That's got to be thought about too, because that's a pretty big drop to go to 34.1 hours from 34.6. That's the equivalent of 2.4 million jobs. So the reason I bring up the unemployment rate and the jobs numbers is so critical is because the dot plot recently showed that while many Fed members were all over the place, 7 Fed members said 3 rate cuts. That's why people say the Fed's telegraphing 3. There was only 7 members that said 3. Some said more, some said less. So whatever. But 12 of the 19 Fed members told us that they see the unemployment rate between 3.8 and 4.1%. And if the unemployment rate were to hit 4.2, I don't think that's a stretch, especially since the Congressional Budget Office gave their projection of 4.4. Now you're going to have 12 of 19 Fed members saying, whoa, we got it wrong. And history shows that the Fed can change their minds quickly. So I think the key for will they taper the balance sheet reduction? Will they cut interest rates or be more aggressive? I think it's going to hinge more on what the jobs numbers come out at as opposed to what the inflation numbers come out at. That's just my take.
More towards recession than soft landing?
It's hard to say if there's going to be a recession or a soft landing. There's a lot of indicators that say that we perhaps are in recession, and some interesting stuff too. We're getting tax refunds are down 29% this year. That taking them from 2,000 a person to 1,400 per refund filer, but 75% of people get refunds. So I don't know, maybe that has an effect this spring on less money to go around. We already know about, Peter's talked about it so much as far as the effect of buy now, pay later. You added 30% increase in outstanding credit card debt. It seems like people are fueling the economy, but they're not fueling it because they're making more necessarily and have more disposable income. They're indebted. It's a debt financed fueling of the economy, which, maybe it can kick the can down the road longer, but I think history tells us that eventually that takes its toll and slows things down.
Peter, you're on a lot of company earnings calls and you're listening carefully to the behavior, what they're doing. What are you, any insights of what you're seeing in terms of jobs?
Well, in terms of jobs, I think overall companies are being just very careful with adding new staff. Barry talked about the BLS numbers. You look at continuing claims today; it's the highest level since November. You listen to a lot of the online recruiting companies like ZipRecruiter. They've seen a clear slowing for many quarters now of a slowdown. In terms of earnings calls, yeah, I think I've heard multiple times companies just saying that they're going to be, just more, careful with their hiring needs. Like when you look at the last couple of years, different type of hiring situations. You had tech that were all competing with each other to try to get the best people, and they overhired. And then you also have the leisure and hospitality. Then you have the jobs where people need to be on premise, whether you need to be at a restaurant, you need to be at a hotel, you need to be on an airplane. Those employers, it took them years to get back the people that sort of went away when COVID hit us hard. They're going to be very reluctant to give that up. So you have this slowdown in hiring, but you have very reluctant employers to fire. So that's why the unemployment rate has stayed relatively low, even though there's plenty of evidence that the pace of hiring has clearly slowed down. And even within the consumer confidence number that came out this week, from the conference board, they said, ironically, people are less worried about the price of food and energy, and they're actually more worried now about the labor market. So that was another interesting anecdote that's pointing to the slowdown in the pace of hiring. And but again, at the same time, employers that are holding on tight on certain parts of their employee base because it was so difficult getting them back after COVID.
So your view overall on the economy for this year, how would you shape that?
It is the most confusing economic situation that I've ever seen. I mean, Barry, just talked about this. The pace of existing home sales near a 30-year low, but then new builds that are trying to fill in that supply need that's doing okay. You have the higher end consumer that's spending on going to concerts, but they're not buying electronics. They're flying on airplanes, but they're not buying stuff for their house. The lower income consumer is still challenged by this cumulative rise in inflation and is being, quote unquote, very choiceful of what the CFO of Walmart has said many quarters in a row about how they spend. You have
Peter,
people.
Peter, can I just add to that? How about the fact that the average ticket price for buy now, pay later items is like $250. And in addition to that, a relatively high percentage of individuals are using buy now, pay later for groceries. So just to underscore what Peter's saying.
Ooh.
Exactly. I mean, the purpose of buy now, pay later was to be able to purchase a big ticket item that you couldn't come up with all the cash at once, whether that was a piece of furniture or something at Best Buy, not to go buy your milk and juice, which, as Barry said, people are now using. You have U.S. manufacturing, you have global manufacturing in a recession. You have government spending that's enormous, that's helping to lift economic activity, building new manufacturing facilities in the Midwest. But how's that going to play out? Because just as we're now building our capacity and facilities to make EV batteries, the demand for EVs are collapsing, and they're piling up on dealer lots. Look at capital spending. We had these pretty good GDP numbers in Q3 and Q4 of last year, but capital spending was basically flat. So we're spending all this money on AI, but what's happening is it's stealing CapEx from other parts of spending, capital spending. So on a net basis, capital spending on equipment, on intellectual property, on software, in the aggregate is flatlining now, which is obviously not a help to GDP. So it's really been government spending, it's been high-end consumer spending that is driving GDP growth. But to my original point, it really makes this a very complicated situation, because then if you take a step back, Germany's in a recession, Japan's in a technical recession, you have China's growth that's slowing, but on the other hand, India just printed an 8.4% Q4 GDP number. And Indonesia is doing better, and Mexico is benefiting from the shifting manufacturing presence of a lot of global manufacturers. So there are just so many cross currents that can make you dizzy.
Yeah.
Huh, great.
And Steve, if it's okay, I just wanted to share what the dilemma at the Fed would be in trying to get to 2% inflation. I could just kind of illustrate it here. So you've got current core PCE 2.85. They want to get this to 2, right? So what we're going to take a look at is the next PCE report. So we're going to get that February PCE report on March 29th. So we're going to remove the February 2023 number. So that'll bring the 11th month total to 2.49. Now we're going to put a placeholder on 3/29 for February's number. So March 29th, we'll get this. Let's just say placeholder is 2%. That still means next month, core PCE is going to print 2.7. Now, obviously, this is just a model, but you can see how this plays out for the Fed. If we were to take 0.2%, not an unrealistic core PCE, but you got to build a model somewhere, right? Here's the replacements from 2023 for February 2023 for March. So the next time that the Fed has a meeting on May 1st, they're going to be looking at 2.55. I think that that's too high of a rate of core PCE for the Fed to go on this alone and make a cut. But watch what happens the rest of the year. As you get into it, we don't really get down below 2.35. And then you actually see it stagnate and tick up a little bit towards 2.45 all the way through. So I think that the Fed's going to have a tough choice. What I mentioned to you before was, and obviously the odds are reflecting that to some degree. So here's the dot plot. Here's what the Fed said. Most of them saying 3 cuts. But what they really think is that the unemployment rate is going to be between 3.8, 3.9, 3 of them do, and then 9 of them 4 to 4.1. So if we get a 4.2 print, and if the Congressional Budget Office is right and we get 4.4, wow. Now you've got 12 members that'll be surprised by 4.2, and 17 members will say 4.4, that's way too high. So they're going to have to take action, I think, not because of inflation getting to its target, but because they're going to be worried about the higher for longer effect and toll it is taking on the labor market potential. That's
So
the
key to Fed probability here is watching the unemployment rate.
in
It's
my
not
humble
gonna,
opinion.
not going to happen with the
I
PCE.
agree too. I agree too. I think Powell's very worried about inflation flaring up again, and he'll need more responding to a decline in the employment situation.
Which goes to your beginning point, higher for longer and interest rates, and then tie that into some of the challenges in the commercial real estate market, and the timing of $1 trillion of funding that's rolling over in the next year. That is that's really a big problem. So if I summarize back a couple of different things here, in terms of it almost is kind of where I think we're moving with the equity markets into a active managers stock selection, sector type of selection play, as opposed to what we've lived through in this low interest rate world and the growth in index funds. So less buy and hold indices, more specific, and maybe tie that into real estate. If I have, Barry, if you had money to invest today, because you are the real estate king in my view, would you allocate cash to select appropriately leveraged multifamily housing type of projects today? Do you see opportunity there? And go ahead.
I do. I see single family as well as being an opportunity. I mean, I'm eating my own home cooking. I've been buying single family real estate here in South Florida. Again, location is very important. So you have to always be careful by location. But by and large, I do see roughly 5% appreciation for 2024. It's going to vary depending on where you are. So it's a nationwide number. But if you use that as an average and you think about if you were properly leveraged and if you were getting rental income that more or less offset the cost of the property to carry it, well, then 5% on, I don't know, a 20% down payment. Now you're talking about a very significant 25% return on your cash. So, that I think that's a worthwhile rate of return. I think it's going to be pretty safe compared to other potential investments that are out there. So I like it. I like it a lot. That's why I've been doing it. And then over time, the longer you hold it, you'll actually become even more positive on a cash flow basis. So it's got varying degrees of benefit. And then depending on your situation, there could be some tax benefits as well. So this to me is an asset class that while it does require a little bit more management and your eye on it, that can be very fruitful, especially over the long run.
Last year when we spoke, you talked about the supply of housing being approximately 5 million units below the demand, and the demand you tied towards the age cohort of somewhere around a 33-year-old, where we are today in terms of demographics and household formation. Any quick thought on that?
Yeah. I'll give you a very quick on this. This is going to run just to sometimes it's better to see it. So the blue lines are households being formed. The gold bars are builders putting up homes, and you could see the mismatch in 2006, 2007, 2008, 9. So we had a housing bubble there. But prices have been very firm because builders, as Peter said earlier, they're not putting up enough homes to meet the demand, which is households being formed. Now, the median age of a first-time home buyer changes over time. And when you take a look back at what happened in the 2006 to 2000 range, the median age of that first-time home buyer, they were born in this period of time here. So abortions were legalized, and the chart you're looking at here is birth rates. So birth rates plummeted after abortions legalized. And what you saw was 2006 to 2010 had a dearth of households being formed. So that's why you saw this. But the reason why this is so strong is because now the median age of a first-time home buyer, they were born in 1987. So that 1987 first-time home buyer today, if you take a look, it's certainly much greater than it was, plus supply is less. But look at what's about to happen in the next 3 or 4 years. You know, if you believe in demographics as destiny, which I do, then this is telling me that over the next few years, you'll even have more demand coming to marketplace, and that demand is going to be looking at a supply that's very, very tight. So I believe this to be in virtually, across the country, in most markets, this should be very supportive of prices going forward. And again, as we said, with leverage, 4, 5, 6% can generate a really handsome return.
So in terms of the commercial side of the market, watch for problems in the regional banks and the smaller banks. That's where the concentration is. And so be careful there. Peter, overall thoughts, like what are you seeing? How are you investing? How are you advising your clients?
So I think it's just a really confusing picture out there, that you feel like the market's at the highs, and you just feel like this level of fragility that's out there. Like we're all skating on thin ice, and I still think that it's going to take time for the economy to, I like to say, acclimate to this higher rate environment. The economic foundation of the global economy for 15 years was zero and negative rates. And we're sort of newly into this higher rate environment. We're just a few years in. And I still think that this is going to take time to work its way through. So, from an investing standpoint, we're trying to find things that are not what everyone else loves, and try to find out things that, try to find ideas that people aren't loving, like our recent, and I'll just throw this out there quickly, and I know we all care about the ag space, but this week the net short position in corn and soybeans for non-commercial traders hit an all-time record high. So to me, we bought the fertilizer stocks, and they've been beaten down. They've been going down straight since Russia invaded Ukraine, which we had owned going into that, then sold it at those highs, but have now bought back in. So I think ag on this pullback, particularly the row crops like corn and soybeans, and plays on that, are pretty attractive right now.
Like that. Thank you. Barry, any concluding thoughts?
Well, I think we covered a lot. So, when it comes to, the markets are going to respond to what the Fed does, both the bond market, the stock market, and then it's related to a lot of other industries. I do think we are going to see some lowering of rates or the balance sheet, which Peter touched upon earlier, but it's such an important part. The balance sheet reduction, I think, will be tapered on the Treasury side at some point, because Peter mentioned it earlier. You had $2.5 trillion in reverse repos. That has come down to about 500 billion. So it's a huge drop off. And what's happened is the money that's come out of there to a great extent has been used to purchase treasuries. So it's been great for the Treasury. It's been great for Janet Yellen. As that dissipates, you can have some freezing up and functioning of the marketplace, or rates would have to go up, which would mean more interest expense for the Treasury and for our government. And that just compounds the issues that we already have.
That to me is the gigantic elephant that's sitting in the room here, and where that problem is. Just the entitlements we have are unfunded $213 trillion, and we got 34 trillion in debt. A lot of that's rolling over. Half of it, I think, is rolling over in the next year, 2 years. That might have been priced at 50 basis points. It's going to be priced at 4%. Ultimately, just the interest expense alone is nearing $1 trillion on the budget. We're operating at a $2 trillion annual deficit. This to me seems to be the real risk in the system. And maybe it's not a today, tomorrow risk, but it's a next 5-year risk where how do we fund this? And
Well,
what,
and throw into that in 8 years, you're going to have a mandatory 23% reduction in Social Security benefits. That's the law. So unless something dramatic changes, this is a problem that has been kicked down the road by politicians and not addressing it because people are afraid to address it. Well, guess what? It's going to be addressed for them, and it's going to be very unpopular if your benefits are cut by 23% without this being so. There are tools that you can go into, all of us can go into, and you could kind of fix the Social Security or fix the deficit. It's hard to do. And while I understand, both political sides say, oh, well, we can either reduce spending or we can just increase taxes. You know, if you take an adult approach and you look at these problems, it's not easy to fix at this point in time, addressing one or the other. It's got to be some sort of a combination. It's got to be some sort of an adult conversation and compromise, because the path we're on isn't good. And Social Security, there's ways to fix it. We've got to raise the retirement age. We just have to do that. You have to maybe think about buying some time with a small reduction in the Social Security tax, maybe 1%, 0.5% to the employer, 0.5% to the employee, just to buy a little time so the retirement age increase can kick in. There's things that can be done, and the more we wait, the harder it's going to get to fix. And I think that will take a toll on the economy as well.
Chancellor's book, The Price of Time, I thought was fantastic. A study of thousands of years of civilizations that have gotten themselves to this debt trap that I think that we're in. And what's calling I guess the spark that's lighting the fuse is higher interest rates. And I don't know how legislators, from a high probability standpoint, don't decide that the easiest thing to do is do what we've been doing and create more money. And that creates more of a problem. And I think we're in the early stages of that spiral of a trap. I'm curious as to what your thoughts are on that.
Well, I think in a way we are currently in that trap. I mean, the 10-year yields at 4.24, the Fed funds rate's 5.5. I mean, a lot of this government spending stoked the inflation that then was followed by the sharp rise in interest rates. So the government created, not only its own mess in terms of how much money they're spending, but they created their own mess from the inflation that lit, and then now they're having to deal with higher interest rates. Now, politicians being politicians, they won't respond until there's a crisis. And the way that I define crisis is a 6% 10-year yield. 5, we just were there, maybe 5. You get to 6% 10-year yield, that's a crisis. That would make everyone in that building, well, it should make everyone in that building scared out of their mind. And maybe it's then that they finally do something. And when we talk about doing something, the government will never reduce the pace of spending. Well, the key is just reducing the rate of its growth. Just by going from 5% spending growth to 4 is a big deal. But they can't even find ways of doing that. And Barry definitely talked about the low-hanging fruit of raising the retirement age, and that would be for younger people, because above a certain age, they're not going to do that just politically. But if you're 21 years old, you're most likely going to be getting your Social Security when you're in your 80s, not in your 70s. I think the biggest difficult part of the budget here is Medicaid and Medicare, because that's on a runway that with no stopping. And I'm not smart enough to know. I don't know how they're going to slow the pace there, particularly with the aging population.
Can I just show you something just to kind of see what I think a potential way that they might try and figure out something? And I'm just going to show you. So here's our balance sheet of outright holdings. So they've taken that down to 7 trillion, and we know that's reducing 95 a month. We know that the TGA right now, the Treasury General Account, the government's checkbook is they've got a little bit of money on it. So between this and what's left in the reverse repos, they could buy a little time, but not much. The clock is running out. So I think that they have to slow down the reduction of the balance sheet. But what could solve the problem? Maybe it's not a solution, but what could maybe band-aid it is, believe it or not, more QE. Because by doing more QE, if you brought rates down, then you would also reduce the debt, because the deficit, I should say, because now
I think Barry froze.
I think he did too. I think about all the time, Peter, how they possibly exit this trap. Our assets are less than our liabilities. So I'm not sure. I'm not sure where that solution is. Unfortunately, we lost Barry. We'll see if he tries to chime back in. And I know
Yeah.
we're bumping up against time, and let's draw to a close here. I really
Yeah.
appreciate, Peter, you taking the time, and your insights are. I follow you all the time on Twitter.
Yeah.
Can you talk a little bit about
Well,
Boockvar report? How people?
you get my Substack every day, don't you?
I don't. I would love to.
I thought you should check your spam because sometimes it shows up there. But
Okay.
yeah, I was pretty sure you were on it, but I will make sure you are.
Thank you. I will double check the spam too. How do people find you and follow you?
That's where on Substack. That's where
Okay.
I'm writing every day. I thought you were on it. I'll make sure that changes.
Appreciate. Okay. Awesome.